This program is brought to you by the National Association of Insurance and Financial Advisors, promoting political advocacy, education, and the ethical conduct of its members nationwide.
Welcome. My name is Bryan Langdon, National LTC Spokesman for Ash Brokerage, and welcome to NAIFA's program in a box. Let's talk about what the future is going to hold with the asset-based long-term care plans. Well, you know, I've been dealing with the long-term care market since 1984, and obviously we've seen a lot of changes in the business. Certainly we've had carriers get in and out. On the traditional side, we've seen a number of rate increases that I don't think any of us would particularly care for. But certainly, there's a growing need and a growing market. And when people ask me, Bryan, what do you see the changes in the long-term care market? I don't talk about the carriers or the offerings from those particular carriers. What I talk about is the change in the general public. I often tell a story of speaking to about 100 clients or potential clients about 10 years ago in Florida. I asked the group if anybody had had an experience with long-term care or knew anything about long-term care, and I noticed that most of the room said no. Most of the men had their arms folded and were sitting there looking at me going, this is never going to happen to me. Most of the women were thinking, well, I can't take care of this 6 foot, 220 pound husband of mine. But certainly there was a feeling and a belief in most of the room that they weren't sure that long-term care would ever have an impact on their life. I contrast that to an event I did about a year ago, also in Florida. A little over 100 potential clients in the room. And I asked that particular group if they'd had any experience with long-term care, knew anything about it, maybe had it touch their family. And I was shocked to find that almost 95% of the hands in the room went up. That, to me, has been the biggest change in the long-term care marketplace. When I go around in country and talk to advisors about the potential of the long-term care marketplace, I hear from veteran long-term care producers that, you know what, it's never been easier to talk about that market. And I have to agree. You know, if you go back 15, 20 years ago, 25 years ago, the pre-baby boomers, in order to take care of their parents, would put them on Medicaid, sweep out the assets, divide them amongst themselves, maybe their kids, and have the state take care of grandma or grandpa. But you know, you can't do that in today's world. With a 5-year look back on asset recapture for Medicaid, the baby boomers today that are beginning to need long-term care are stunned that they have to reach into their pocket for at least 5 years before the state will pick up the tab. That and the fact that we are certainly living longer, and you will see a slide in a couple of moments that will illustrate that, tells us that the impact of long-term care is being felt all over the United States. You know, not too long ago, and of all places, Manhattan, I had a very wealthy individual say to me, you know, my husband and I have been very fortunate in life. We can write the checks for my father-in-law. But you know, I'm never going to have my kids go through the same process. There's stability in the asset-based long-term care plans. In fact, to my knowledge, no one has gotten in and gotten out. What's happening in today's world is we have a number of carriers getting into the asset-based long-term care market. We're almost 10 carriers strong, and we have a number of carriers that are on the sidelines getting ready to jump into the game. There's opportunity. You know, if you take a look at a potential marketplace for an advisor, I always like to say, what other sources out there might compete with us as we look at a potential market? And by that I mean the federal government. And we all know that through the Affordable Care Act, there was a long-term care piece that was the first section of the Affordable Care Act to be ejected. and then eventually repealed. So we know our government's not going to step forward on long-term care. We take a look at the states, and we know that state Medicaid budgets are certainly stretched extremely thin. The next economic downturn will certainly have an impact on it. And back in the fall, I did a joint long-term care event with the insurance commissioner from Kansas. We had a large group. We had over 300 people in the room. But before we started, as we were setting up on the dais, she and I began having a discussion about private long-term care insurance, rate increases, and where she saw the market was going. She said something very interesting to me. What she said was, we have to have a solid and thriving private long-term care market in today's world, because if we don't, then my state, Kansas, and the other 49 states will all go broke trying to pay for the nursing home costs for our senior citizens through the Medicaid program. So that tells me that not only do our legislators and our regulators recognize the viability of private long-term care, we also have the general public who is coming to us in more numbers and saying, hey, I need help planning for this potential risk. So we're not going to have government regulation. We've got a population growing that has a need for our services, and we're now having the products to hit the marketplace to help that planning process. And yes, carriers are bringing innovation into the asset-based long-term care field. Recently, we had a new carrier enter the marketplace that pays their benefits as an indemnity. So let's say you work in a particular rural market where it might be hard for a home caregiver to drive 45, 50, 60 miles to their clients to provide 3, 4, 8, 10, 12 hours of home care in a home. So you have the option of looking at a particular product that pays the benefit as an indemnity. So maybe that farmer that has a long-term care need for the spouse can go into their local community and have somebody sit in the home and help with that home care delivery, as opposed to having somebody drive a long way. Again, innovation, flexibility, and what that means for us is that we have that option of bringing folks together with the coverage that they need. Again, a planning process, not a purchase process. Now let's take a look at the next slide. And this is an issue that I think all of us need to consider when you're talking about long-term care planning. You know, I have a lot of people who say to me, well, what are my local costs? What are the costs in my community today? And my response to that is, long-term care is a different product. You know, our clients buy coverage, but they may not use benefits for 15, 20, 25, maybe even 30 years. So what's interesting about our planning process, and something that you should consider, is not only what the costs are today, but more importantly, where are those costs going to go in the future? You know, there are some care studies out there that we can all refer to, but a lot of those care studies are saying to us that costs are growing by 4 or 5%. Well, I'm not a mathematician, but I can tell you that costs going up at 5% a year will cost a nursing home, an assisted living, home care to double in a 15-year period of time. So as you're thinking about doing the planning process for your particular client, make sure that you think into the future. Make sure that you try to peg coverage somewhere around 75 or 80. Because you want to make sure where the coverage is going, not where the coverage has been. And as we're talking to our clients, we want to make sure that we're looking on that long claim horizon for them to think about. Also, don't necessarily just focus on nursing home costs. If you look at reimbursements from all of the long-term care carriers out in the marketplace today, over 50% of reimbursement in today's world are going for home care costs. And certainly we know that our clients would much prefer to be in an assisted living facility as opposed to a nursing home. And I believe that clients that have proper long-term care coverage, that have that funding mechanism, are finding the coverage they want, which is coverage at home, or in an assisted living facility. So when we're thinking about future benefits for our particular client, make sure that you're thinking 20, 25 years down the line or around when they're 75 or 80. And make sure that you also consider what home care and assisted living costs are, because they're much more likely to receive care in that environment as opposed to a nursing home. Now let's take a look at the actual solutions that are out there for us. The first, which has been around the longest, are the life-based long-term care, a life chassis with long-term care benefits. We're now finding a non-qualified annuity dollars, non-qualified annuity plans that are combining with long-term care benefits. And now we have a number of life insurance carriers out on whole life and UL chassis that are introducing a rider that allows you to draw down the face amount dollar for dollar in order for long-term care needs. Now, all of these products work exactly the same way. The triggers are exactly like traditional long-term care, either the inability to do 2 of 6 activities of daily living or a cognitive impairment. As you see on the slide before you, you have a whole lot more choices in the long-term care planning process. You know, years ago, the long-term care process used to be a purchase process. Our clients would come in, we'd talk about $150, $200 a day, 5% compound, unlimited benefits with a 90-day elimination period. We'd send that off, we would have some numbers come back to us, and we'd put it in front of our clients, and that constituted the long-term care planning process. You can't do that any longer. With all of the solutions that are out there, we need to do a fact find, we need to understand our client, we need to know how much income that they're going to have at 65, 70, 75, and 80. We need to understand what their asset picture is. We need to know about their 401k, their investments, maybe whether or not they have a pension. Maybe they've got rental income. But by understanding the entire picture of our particular client, we now can introduce the solutions that you see before you. Let me give you an example. A couple of years ago, I was speaking to an advisor in Nebraska, and he said to me, I have a client who's interested in long-term care. So my response is always the same. Tell me about your client. So he talked about their income and what he thought they would have in income at 75, 80, 85. But then he began to tell me about their assets, their savings, their 401k, a small pension that they had. But he hit on something that sent a flag up. He mentioned that the wife had a non-qualified annuity that she hated. She bought this annuity in 1994 for $100,000, and today it was worth $174,000. And I said, how about we take that annuity, we triple it for long-term care if they need it, and we add her husband to it. Well, the advisor loved the idea. And soon, within the course of the day, in transferring that information to his client, the client got just as excited. And immediately we took steps to moving those funds in that annuity hybrid to solve for long-term care. And as you can see, with the 3 different ideas in front of you, you now have a whole host of options as you're talking to your clients and thinking about what the future holds for their long-term care plan. So what I tell advisors all the time is, long-term care is not necessarily a purchase process anymore. It's a planning process. And that planning process requires us to do our due diligence, to do that fact find, and understand the total picture of the client so that we can make the best decision with them. Now let's talk a little bit about the history of the riders. You know, how many of us that have been in the long-term care market for a long period of time have heard, hey, what if I don't use it? Well, my response is always, I have homeowners insurance, and I never drive home at night, park in my garage, and then step out and look at my house, and I'm disappointed it didn't burn to the ground so I could use my homeowners insurance. Years ago, I lived in Austin, Texas. I was driving home late one night from the airport. I thought I could either go north around town, I could go south around town, or I could go right through downtown so that I would miss the deer that were out. Well, I went through town, and I didn't miss the deer. But as I pulled my car over to the side of the road, I didn't immediately get out and jump up and down and say, great, I get to use my auto insurance. But that issue, when it comes to our clients, has always been in their mind. So some carriers got together, put their heads together, and came up with the hybrid long-term care solutions. And I will say to you, it is the one insurance solution that you're going to get paid no matter what happens. Frankly, I hope our clients don't have that long-term care event. But having either the annuity count or the life insurance amount to pay back, or even the life insurance with the rider, those residual benefits to pay back the estate income tax-free will absolutely make sure that your client is going to collect one way or another. You know, we need to understand the leverage and the continuation of benefits. And you'll see as we talk a little bit more in detail about the products of where the leverage comes in and how important the continuation of benefits are to the plan. Certainly, we take advantage of the tax law benefits. You know, the great thing about long-term care benefits are they are income tax free. We actually have some carriers in the marketplace who are beginning to have claims that either approaching or leaving over $1 million in benefits, again, all income tax free. So our hybrid long-term care products do a great job of taking advantage of the tax laws that are out there and taking them for the benefits of our clients. So let's talk a little bit about how they work. Well, usually we'll have a single deposit that will allow leverage to create long-term care benefits. We'll have the annuity account that the client will still own that will grow over a period of time. Or we'll have the life insurance chassis that will have the life insurance residual amount to pay back the estate income tax-free if they don't use it. And the great thing is our clients don't lose control of the money. How can you say that? We move the assets, we create the leverage, we pay them whether they use the long-term care benefits or don't, and at the entire time they retain control of the assets. A great way to plan for your long-term care needs. There have been product changes over time. And certainly we mentioned a little bit earlier that the interest rate environment has caused some of the carriers to lower the leverage for their long-term care plans. But you know, my experience in the long-term care business is not that clients necessarily worry about that leverage, they worry about cost. And we're going to illustrate this for you a little bit later in our discussion today, but frankly, when it comes to the asset-based long-term care plans, the true cost is the opportunity cost of the money that your clients are giving up. And again, we'll illustrate that for you in a moment. So even though we're in a low interest rate environment, even though that leverage has been reduced, clients don't necessarily focus on that as much as they do on the opportunity cost of the money. There are new carriers, as I mentioned a little bit earlier, that are getting into the market and more still planning to get into the market. Well, that's certainly good for us and good for the industry. You know, our traditional long-term care market has taken a hit with a number of carriers who have exited the market. But in our hybrid-based long-term care market, we're seeing more carriers again get in, which gives us additional choices, additional options, and again, allowing us to provide the absolute best solution for our clients. Used to, on the hybrid side, benefits were paid as a reimbursement. But in today's world, with innovation, with additional carriers, we're now finding carriers that are coming into the long-term care market, the hybrid market, with an indemnity option. Now, you won't create as much leverage for your particular client, but that indemnity option will give additional flexibility, especially for individuals who live outside of urban areas and may find finding a caregiver a little bit more difficult than most of the places in the United States. We're seeing enhanced features coming along with innovation in the marketplace. You're beginning to see some of the carriers take a look at what they're earning and their investment counts and maybe applying some additional benefits to our hybrid options. You know, that hybrid long-term care market is in a flux. but not stepping back, but stepping forward. Now let's talk specifically about benefit triggers for long-term care. Again, this is certainly a change. You know, the claim horizon for a long-term care client can often be 20, 25, 30 years. But we're now in an environment where we're beginning to have some of our clients who have claims. In fact, not too long ago, in talking to an advisor, he said, yeah, you know, I've had almost 20 long-term care claims over the years. And I said, well, what do you find with your clients that go through that process? He goes, well, number one, they're actually thrilled. And the family and the support network is thrilled to find out that the client actually has long-term care coverage. He said, but you know, they often struggle with that waiting period, and they struggle with the actual triggers in the process because, you know, my clients are like everybody else. We talked about this particular concept years ago. They bought it, they paid the premium each year, but they stuck the policy in a drawer and only pulled it out when the event happened. So let's kind of go through the triggers for the asset-based long-term care, again, just like traditional, and that in order to trigger the benefits, you have the inability to do 2 of 6 activities of daily living, or you have a severe cognitive impairment. You must have the 90-day certification that the condition will last at least 90 days. Let's not forget that. And we have to emphasize that there's that policy waiting period. Now, the hybrid long-term care policies are kind of all over the place. And certainly, as you begin to learn more about them and the particular nuances of the particular carriers out there, you want to make sure that you understand. Do they have a waiting period for home care benefits? Maybe they don't have a waiting period for home care, but they do for nursing home. Maybe they have a reduced waiting period. Is it a one-time waiting period? Again, all details that we need to understand, but more importantly, we need to highlight for our clients. Certainly, when you sell one of these concepts, you want to make sure that you highlight in the policy language how the waiting period works for the client. They're not going to remember, but when you want to go back to the document, the policy, and use it for the client at the time of claim, you want to be able to point and discuss the fact that you understand the nuances of that particular policy. Now let's talk about the actual details of our 3 options today. I'm going to start with the most popular. And by the way, the market for this particular idea is expanding. Last year, over $1 billion of hybrid life long-term care benefits were written. So it's on a life insurance chassis that we're going to leverage for long-term care benefits. It comes with a life insurance kicker to pay back the estate, income tax-free in the event that the client doesn't use the long-term care benefits. As part of the innovation that I talked a little bit about earlier, some of the carriers now offer flex pay options. Other carriers are considering it. For example, you know, on the traditional side of long-term care, years ago we used to have a single pay and we used to have a 10 pay. Well, when folks approach us today and ask, hey, do we have any limited pay long-term care, we'll often recommend that they look at flex pay hybrid long-term care policies. Again, the benefits are locked in, the premiums are locked in, and that you might be able to pay in 1 year, 3 years, 4 years, 5 years, even 10 years in the process. There are return of premium options along with the hybrid long-term care plans. And let me emphasize this. Your client never loses control of the asset. It's often moving from the left pocket, moving it into the right pocket, creating that long-term care leverage, but making sure that your client still has control of their asset. So let's take an actual case study of a 60-year-old non-smoking female. We just talked about the benefits and the leverage that it creates. But as you're thinking about this particular concept and as you're looking at your book of business and your community, you want to make sure that you think about a couple of things. We've got a 60-year-old non-smoking female who's moving in $100,000. The question that you're going to have is whether or not I put in the inflation option on that particular individual. Now, most of the hybrid long-term care products out there have inflation options, but it usually takes about 14, 15, 16 years for that inflation option to go past what you would have had should you have chosen no inflation. And by that I mean this. If you take this 60-year-old with no inflation options, she's going to have somewhere around $450,000 of long-term care benefits. If you decide to add the inflation option, she'll start with probably a little less than $300,000 worth of long-term care benefits, but it will grow over time so that when you're 16 years down the line, you will pass that $450,000 of benefits and create even more growing benefits over a period of time. That's a question you're going to have to discuss with your client to determine whether or not you add that benefit. We like to tell folks that you want to target benefits for age 80. You want to make sure that when you're working with clients to set up your long-term care benefits, that you target somewhere around age 80 because frankly, that's when their highest probability that they may use it. And then you're going to finish with that question of, do you want a reimbursement plan or do you want an indemnity plan? And again, your reimbursement plans generally will create more leverage than your indemnity plans, but you don't have that same flexibility of being able to have that monthly benefit in your checking account to spend any way that you wish. Now, let's take a look at the linked benefit annuity hybrid. Non-qualified dollars. Now, there is a carrier out there today that will say we'll take qualified dollars for annuity hybrid, but you're not escaping taxation on the withdrawals. What they do is they level out the withdrawal over a period of time to make sure that there are equal installments, but it is a taxable event. You do create leverage for long-term care, but more importantly, the gain that you may have in those non-qualified annuity dollars can come out income tax-free to pay for a qualified long-term care event. Let me repeat that. The great thing about a non-qualified long-term care annuity hybrid is that if your client has a gain within that annuity, those annuity dollars, that gain can come out income tax-free to pay for a qualified long-term care event. The leverage, depending on the age, is somewhere around 2 to 3 times. Most plans will allow you to go up to 80. In fact, some plans will actually allow you to go to age 85. So on the older end of the spectrum for your clients, you do have some options with the annuity hybrid. Okay, let's take a look at some of the medical questions that are out there when it comes to long-term care. Now, I've chosen the annuity hybrid to focus on, but understand that this also applies for your life insurance long-term care hybrid and the life insurance with the rider that allows you to draw down the face amount income tax-free. Carriers are going to ask if you use a wheelchair, walker, dialysis, oxygen. Do you receive help currently with your activities of daily living? Do you have a diagnosis of Alzheimer's, dementia, organic brain syndrome, and other conditions? In fact, not too long ago, in going with an advisor to meet a client on long-term care planning, we had a great meeting. And the client and the spouse definitely interested in a long-term care annuity hybrid. But in our discussion and asking about the health of the client and the spouse, they were happy to say that they were taking no meds and they were in great health, even though they were in their mid-70s. And as we got ready to leave, in fact, as I got to the door, I said, wow, no meds whatsoever. And the wife looked at the husband and said, honey, you remember you're taking that one little pill, just one, less than 5 milligrams a day. And he said, you know what, that's right, I can't quite remember what that is. And they went back and forth, and they finally decided that it was Aricept that they were taking. Well, I'm sorry, but Aricept is used to treat Alzheimer's. So even I, with all of my years in the business, almost got out the door before I was able to determine whether or not that client was able to qualify for long-term care. I had to slowly take my jacket off, sit back down at their table, and explain to them that unfortunately the husband was not going to qualify for any kind of long-term care option, and we now had to focus on his wife. Always remember, as you go through these medical questions, that having a general idea of where your client stands medically early in the long-term care process, whether it's traditional or hybrid, critically important. Because frankly, if they can't qualify, you don't have a potential client. Now, let's take a look at this pool growth as we talk. This is a general annuity and long-term care hybrid. For $100,000 on a 70-year-old, you immediately are going to create $267,000 at $4,451 a month. If your client moved the monies at the end of the first 5 years and needed long-term care, they'd have to get a pre-tax rate of return to match the benefits of over 27%. Look at year 20, where that original $100,000 is now grown into $320,000 with a monthly benefit of $5,344. If your clients moved the money and in year 20 started taking long-term care benefits, they'd have to have a pre-tax rate of return of 7.5%. Hard to beat that in today's market. Now, let's look at an actual case where we've got a 70-year-old female with $800,000. The female is living off that $800,000, but at age 80 has a long-term care event that lasts 5 years. Her benefits were $6,850 a month. And so in that period of time, her estate paid out $411,000. Because she's living off of 5% of the $800,000 over a period of time and has that long-term care event at age 80, you'll find that by age 89, the entire $800,000 between living expenses and her long-term care event has wiped her out. But if her advisor at age 70 had said, you know what, let's take 100 of that $800,000, turn it into an annuity with long-term care benefits, and we had the same long-term care event of $6,850 a month in benefits for a total 5-year period of $411,000, because she had the annuity hybrid long-term care benefits, at age 90, she'd still have almost half of her $800,000. No planning at age 70, she's wiped out at age 89. By moving just 100 of the $800,000 at age 90, she still has almost $400,000 of her estate with her care. These slides show the importance of long-term care planning. Now, it could have been the life hybrid, it could have been a life insurance with a rider. In this case, it happened to be a non-qualified annuity hybrid, but the important issue is that the leverage created by the benefits help the estate stay forward, stay funded. So let's take the idea of a 70-year-old male with a $100,000 deposit. Now, he's not going to create as much leverage as the 70-year-old female. The 70-year-old male will create about $250,000 initially when it comes to long-term care. But again, remember, when you're dealing with your clients, that the gain in a non-qualified annuity that they have can come out income tax-free for long-term care benefits. So if I'm there sitting with you today in the room, and I'm thinking about my clients, I go back to my office today and I think, how many clients do I have that are out there with non-qualified annuities that are at 65, 70, 75, maybe even 80, who don't need the income off of those annuities, who are worried about medical costs in retirement, and now I have an option to leverage those dollars for long-term care. Now I have an option that would allow them to reach into that annuity to take out the gain, income tax-free for qualified long-term care benefits. I have leverage, I have access, and now I've taken an asset that they're not using and I've put it to good use. Okay, so now let's look at our last idea that's frankly pretty new in our industry, and that's the accelerated benefit life insurance. As I mentioned a little bit earlier, usually on a whole life chassis or a UL chassis. And the benefits that are out there today, or the riders that are out today, are usually qualified into two different areas. One being a chronic illness rider, one being a pure long-term care rider. And let me make sure that I explain the difference to you today. Your pure long-term care rider is going to work exactly like every other long-term care plan in the marketplace today. The triggers are going to be off of the inability to do 2 of 6 ADLs or a severe cognitive impairment. You will be able to take the life insurance amount and draw down the face amount by the benefit that you select, usually 1, 2, 3%. Some carriers actually will let you draw down 4%. So if you had a $200,000 face amount and you had a 2% rider, you would be able to draw down $4,000 a month. The benefit would stay in force as long as you had money into your deposit or in your face amount. Or you have a chronic illness rider. Now, the chronic illness rider is triggered by the inability to do 2 of 6 activities of daily living or a severe cognitive impairment. And the condition must have a nature of permanency. So a little bit different than your pure long-term care rider, but you will find that your chronic illness riders usually priced a little bit less than your pure long-term care rider. And you will find that your chronic illness rider is paid every time as an indemnity, not as a reimbursement. Now, that doesn't mean that the carriers are out there that are offering the true long-term care rider won't pay as an indemnity. Some do and some don't. But let me make sure that we tell you the differences again. And let me reemphasize. You have a rider that allows you to draw down the face amount of the life insurance dollar for dollar. Usually pick 1, 2, 3, maybe even 4%. In the example that I used a couple moments ago, I used a $200,000 face amount at a 2% rider, which means you could draw down $4,000 a month. Now, that will either be as a pure long-term care rider, triggers being 2 of 6, the inability to do 2 of 6 ADLs or a severe cognitive impairment, or a chronic illness rider, which is, again, 2 of 6 of the ADLs or severe cognitive impairment, and your condition must have a nature of permanency. Now, depending on which rider you choose, if it's chronic illness rider, each time those benefits are going to be paid as an indemnity. If it's pure long-term care, some carriers will pay it as reimbursement. Some carriers will pay it as an indemnity. Again, a scenario that you need to understand the actual language of the long-term care or the chronic illness rider and how it fits with your particular client. But let me talk about a couple instances where I think it fits particularly well. Again, I'm going to go back to those of you who work in rural communities. Think about it. If your client's in a situation where they're out pretty far away, and it might take a home caregiver anywhere from 45 minutes to an hour, maybe even longer, to travel to your client to actually provide that care, maybe what you do is instead of looking at a traditional long-term care or a long-term care hybrid that pays it as reimbursement, what you say to your client is, I have the option to give you pure long-term care benefits and a benefit as an indemnity, so that the client now has the cash to spend how they want for their long-term care need. I had this discussion with a carrier that we do business with not too long ago. And their wholesaler looked and said, you know, I hadn't thought about it like that. But that goes back to the idea that we talked when we first started with our discussion today, which is, if you understand all the different pieces that are out and available to you in the marketplace today, you can tailor the solution to your client to fit their needs, whether it be the leverage that they're looking for, the coverage that they're looking for, the options that they have in order to fund their particular long-term care hybrid option, or in the benefits that they want or that they're looking for, so that you can match up funding with leverage with benefits to fit your client's picture. So, let me give you an idea of a 65-year-old male or female who are taking a look at the life insurance with the rider. You can do it as a lump sum. You can do it as a 1035 exchange. In fact, let's think about this for a second. We're in 2015. But when our baby boomers began to retire 30 and 35 years ago, when they were 28, 30, 32, 33, 34, starting their families, buying their first home, what was their concern? Well, their concern was, I need life insurance. I need to be able to protect my earning. I need to be able to protect my family, my home, my children's education. Well, now let's take over a period of time, and as they begin to mature and head towards retirement, what happens? Their risk profile changes. Does a 62-year-old have the same risk profile as a 32-year-old? I dare to say no. Because at 62, that client is not necessarily worried about the home and the kids. They've gotten the kids out. That home often is close to being paid for. But then now they're worried about, is my income going to last? And am I prepared for medical costs during retirement? So as you're thinking about that profile, and that client is looking at the life insurance policy they bought 30 years ago, here's a question that I hear every day. Do I still need that life insurance? I would say yes. But do you necessarily need that life insurance in the same format as if you bought it 30 years ago? Maybe no. You now have the option, if your client is looking to create some long-term care coverage, of taking that cash value from an old life insurance policy and turning it into a new life insurance policy, one that offers flexibility and access for long-term care costs. So again, as you go back to your office today and you're thinking about your clients and you're thinking about those clients who have purchased life insurance from you many, many years ago, and in today's environment have a change in their risk profile, that now they're more worried about medical costs as opposed to dying too soon, you have the flexibility to help that client do so. Additionally, I have a number of individuals who will come up to me and say, oh, great, I've got the life insurance with the rider. What I can use now with that plan is I can replace my traditional long-term care plans. Won't necessarily work that way. In this particular case, if you're 65-year-old, either male or female, the premium for each one will be anywhere from $5,000 to $6,000, maybe even $7,000 a piece for $200,000, $250,000 of face amount with your rider. Pure life insurance, whether it be whole life or UL, with a long-term care rider will typically be 30, 40, maybe even 50% more expensive than your traditional long-term care plan. It works differently. It provides different benefits, I think a little bit more flexibility, but understand it's not necessarily going to replace that traditional long-term care marketplace. Okay, so let's sum up what we talked about today. Let's take a look at the marketplace. As I told you a little bit earlier, in my experience, the biggest change in the long-term care market, not the carriers that have gotten in and out, not the rate increase that we've experienced, not even the hybrids. The biggest change that I see is the general public's acceptance that long-term care planning belongs in the retirement process. Yes, the introduction of the hybrids have been great for the industry. It has turned the long-term care process from a purchase process to a planning process. but you need to understand and learn your options. You still have that traditional market, but you've got the life chassis with long-term care benefits. You have the annuity, non-qualified annuity dollars can be leveraged with long-term care benefits. And you have UL and whole life chassis out there with riders that allow you to draw down the face amount dollar for dollar. You truly have the options to create a great plan for your client. As you go back today, again, you're in the car heading back to the office, begin to think, what clients do I have with non-qualified annuity dollars that frankly aren't happy with the options that they have today? Think about the life insurance that you sold 25 and 30 years ago where your clients are thinking, does that life insurance still do the same thing that I needed 30 years ago? Think about the lump sum opportunities with clients with rainy day funds, monies in CDs or money markets that you can now leverage 3, 4, 5 times to create a long-term care plan for your client. Yes, long-term care has turned from purchase to planning, but now you have the ability to create that long-term care plan with a stroke of a pen, not the writing of a check. We hope you enjoyed today's information and that you got something out of it. Thank you for joining.
Thank you for participating in this program. For more information regarding products, programs, services, and other NAIFA member benefits, visit www.naifa.org.